Hello everyone. Mini Professor Olivier is back again. Are you ready for a new weekly analysis of financial markets? If you enjoy this weekly video, please show me your support and like it below, you will make my day. So, let's start. The mood turned decidedly risk-off either side of the weekend, as investors focused their attention on two major concerns, growth and inflation. Shares fell sharply in Japan and Hong Kong, before similar slides were recorded in the UK and continental Europe. The growth story is in turn focused once more on COVID, and in particular, the highly transmissible Delta variant, which is currently running amok in places that have failed to keep up with the vaccination rollouts in the developed world. Countries like Russia, Bangladesh, Vietnam and others are seeing a massive upsurge, not just in cases but in COVID-related deaths too. The coincidence of the Delta upsurge, and the arrival of so-called Freedom Day in the UK, is one of the pandemic's bigger ironies. Letting young people loose in nightclubs, and encouraging people back to work, while taking away the legal requirement to wear masks, but making it difficult for people to get away on holiday for a second summer looks inconsistent. It will either be looked back on as a bold step towards herd immunity, or a public policy disaster. We can only wait and see. Meanwhile, the inflation story bared its teeth last week with unexpectedly high consumer prices prints on both sides of the Atlantic, above 5% in the US. The debate about whether or not the rises are temporary spikes or something more serious continues, and markets are frankly confused. The bond market is counterintuitively back in favor, as investors bet that flagging growth is a bigger concern than rising prices, and it buys into the Fed's argument that price rises are transitory. The 10-year U.S. Treasury yield fell back to 1.25% at the start of this week, well down on the 1.75% peak in the spring, suggesting that investors do not think the Federal Reserve is about to be forced into drastic tightening measures by spiraling inflation. Germany's 10-year yield meanwhile hit -0.37%, its lowest since March. The stock market seems more worried by growth than inflation for now. The S&P 500 had its worst day in a month on Friday, down 0.75%, and the negative sentiment spilled over into Asian and European shares on Monday. In a sign that investors are increasingly looking for safe havens, the dollar hit a three-month high against sterling. A mismatch is building between the still high overall level of the stock market and what is going on beneath the surface. First, there has been a dramatic narrowing in the breadth of the market, with only 30% of S&P 500 constituents currently standing above their 50-day moving average. It is extremely rare for a market to hit an all-time high when so few companies are doing the same. In fact, the only times this has happened have been shortly before significant corrections of the market, by 20% in 1998, and by more than 50% in 2000. No one is saying that history will repeat itself, but for some time now parallels have been drawn with the correction in the summer of 2010, when the post-financial crisis V-shaped recovery ran out of steam. That was a period when the market stalled, as it moved from the early cycle hope phase of rising valuations to the mid-cycle growth phase of rising earnings. This is rarely a smooth period in markets. Part of that process seems to be a distinct rotation back from value to growth. Just 6 months or so after the discovery of vaccines last November seemed to promise a path back to normality. The only segment of the market that is really holding up now, and this is what is underpinning the overall index, is large growth shares. Smaller growth shares and all types of value stocks are going sideways or retreating. This might seem at odds with the high inflation print last week, which would normally be expected to favor cyclical and value shares over defensive, growth plays, but it does give ammunition to those who argue that rising prices are just a reflection of unusual year-on-year comparisons, and not the sign of a more entrenched price spiral. One further plank in this argument is provided by the divergence between shares and commodities in recent weeks. The supercycle in economically sensitive commodities like industrial metals has been put on the back burner for now. So, there are things to worry about for investors, but one thing that does seem to be going according to plan is earnings season. It is still very early days, with only around 40 of the 500 biggest U.S. companies having reported so far, but the expected growth rate in earnings in the April to June quarter, versus the same last year, is now up to 71%, and the full-year calendar growth expectation is now up to 37%. This means that even if sentiment falls away due to COVID and inflation fears, the stock market may be able to hold on to recent levels. It's a fragile market, but not necessarily one that is bound to correct. This week, attention will shift from the banks which kicked off earnings season strongly last week to the tech companies, with Netflix, Twitter, Intel, IBM and Snap all due to report. It will be interesting to see whether the tech sector continues to live up to its reputation for fast and stable earnings growth. If it does, and with expectations of an earlier-than-expected hike in interest rates now fading, investors will remain attracted to this part of the market. One commodity that has risen sharply over the past year, and so far has largely held on to its gains, is oil. That is because it has benefited from a double whammy of rising demand, as economies reopen, and restricted output, as OPEC and its main ally Russia have stuck with production curbs designed to dig the oil price out of the hole it fell into during the pandemic. A year ago, we watched as briefly producers were paying others to take oil off their hands, because they had nowhere to store it. Even once that crisis passed, the oil price was languishing at a level in the $20–30 range where countries like Saudi Arabia faced challenging budget constraints. Their response was, as it always is, to cut back production to boost the price. And it has worked well. Recently, however, the unified front presented by OPEC has started to fracture, and disagreements have emerged, particularly with the United Arab Emirates, Saudi's small but influential neighbor. The oil cartel this weekend agreed to raise output, in order to put a lid on a price which has reached nearly $75 a barrel and threatened to head towards $100. OPEC and its allies have now set the end of next year as the target for restoring all the output withdrawn during the pandemic. In terms of policy announcements, this week's focus turns to the ECB, which meets on Thursday, just a couple of weeks after the European Central Bank concluded a strategic review that opens the door to the ECB, following the Fed's lead in tolerating higher inflation in a bid to avoid becoming trapped, Japan-like, in a permanent low-inflation, low-interest rate world. Whether agreement is any easier between Europe's disparate countries as it has proved between OPEC's different constituents is a moot point. Germany has called recently for the ECB to start winding down its bond-buying program, reverting to its traditional position as the bloc's biggest inflation hawk. However, for now, there seems little to suggest that the central bank will not remain in the lower-for-longer camp, maintaining stimulus even after inflation rises above target. That's all for this week. I hope you found this markets update useful. Please don't forget to like it below, and you'll make my day. Thank you very much again. I wish you all an amazing week. Goodbye.